Hey there, here's a quick note. This podcast contains general financial advice only. That means it's not specific to you, your needs, goals, or objectives, so don't act on the information until you've spoken with your financial advisor. You'll find our full disclosure, disclaimer, and link to our financial services guide in the show notes. Pat, welcome to the Australian Investors Podcast.
Great to be here. Thanks for having me, Owen.
Yeah, we're recording remotely. We're both in Melbourne, but we're recording remotely today. We've got a lot to talk about. We'll talk about robo advice, about portfolio construction, automation, and all of those fun things. But I'm hoping maybe we can start off with a bit of quick fire, mate. And I've got two questions for you. The first is, what's more underrated with a 10-year view, so we're talking long-term, the technology or resources sector?
Interesting time for that question. Here in late July. I would probably answer that as slightly different in that I think I would say the more appreciated sector from Australian investors seems to be technology, in that as I look at what ShareSite and SelfWealth and others are reporting about investor behavior and trades and what people are holding, I'm actually pleased to see that fairly standard but good large global share ETFs are towards the top of the list, and by definition they would be highly weighted towards technology. So I think people are using and continue to use the big international ETFs as a way to get exposure to a diversified group of companies heavily weighted to technology. So I would probably say resources might be more underappreciated. But as I say that, there is a lot of money being invested in resources entities because we're in the midst of an energy crisis. And so I also see that, BHP, Rio, and others that are suppliers in renewable energy and inputs and whatnot have got a lot of attention recently. But I think as far as long-term, there's more appreciation for technology amongst Australian investors at the moment.
Yeah, it's a tough question. And purposefully, 10-year view, we Aussies, we love our resources sector because it tends to, even though they are cyclical, we tend to get fully franked dividends. And the technology sector, although, by and large, Australia isn't that large when it comes to the technology sector, we do like our technology companies, and we are prepared to look abroad for that. So, and by the way, that wasn't a forecast. I wasn't trying to angle for a forecast from you. I wouldn't have expected you to do so. But the second question for me, mate, is more of a personal one, quite an easy one. What's the best beach that you've ever surfed?
I'd have to go Bells Beach. And to be clear, I could never surf Bells if it was pumping. But I did surf it once when it was when the locals probably thought it was too small. And I was able to get a wave there, and it's so iconic and so beautiful. That memory will never leave my mind.
Bells Beach here in Victoria, down near Torquay. It's a fantastic spot. It's definitely a place where you would go if you're a keen surfer. Maybe not so much if you're a beach goer or you have toddlers or something like that. There are plenty of other beaches nearby. Jan Juc comes to mind. Mate, that's great. I like to start these interviews by going back in time a bit and trying to understand the person that has created an investment strategy or investment company like yourself, and just understand a bit more about how you got to where you are today. So what was a young Pat like? Did you want to get into investing? Did you have mentors in business or finance? How did this come to be?
I think the underpinnings of an interest in investing and the mechanics of that existed with me at a young age, but didn't manifest till a little bit later. In that I went to uni and studied engineering and commerce. But as a young kid, I was really interested in puzzles. I'm much more of an analytic, mathematical mind than I guess you might call the liberal arts in the States. So I enjoyed building things. I enjoyed trying to figure out how different pieces of activities fit together, and that's just the way my mind always worked as a kid, which is in part probably what led me into the engineering degree. Investing was something I knew of and was familiar with, but I didn't have a super keen early interest in it because I didn't have money to invest. And so then I go off to uni, and then I get to New York, and I was actually in the operations area of New York for a little while, and it wasn't until a little later of my time there that I actually had some savings to invest, and I'll touch on that in a minute. But I think it was mainly just the analytic aspect of investing, and then as far as the business, it was really the interest in creating and building things.
So out of school, did you out of uni, did you go and work as an engineer at all, or did you move straight into the operation side of finance and investing?
Yeah, I went. One of the things I learned in engineering school at the University of Virginia was that I probably didn't want to be an engineer, but I was quite grateful for the skills that I learned. My major was something called systems engineering, which is probably most closely aligned with what management consultants do in terms of, again, that sort of the analytic rigor of breaking complex things down into the simple components, figuring out how they all interrelate, and then being able to manage that better or optimally. And but I didn't want to necessarily be an engineer, so I had a minor in commerce, and sort of a comedic story, which I won't elaborate on. I did end up managing to get a job at J.P. Morgan in New York, inside the management consulting, effectively the management consulting arm, which was kind of sat next to the corporate finance and M&A and whatnot. It wasn't an easy role to get, but I had the right background for it. I didn't necessarily have the right background school-wise to get what was at the time, this is 1989, probably the hardest job to get as a college grad in America, which was a finance internship at JP Morgan on Wall Street. So I didn't try. I got a foot in the other door, and then managed to sort of meander my way across. But no, I went straight into 1990 up to New York, and was there for 10 years at JP Morgan.
So you're in this like business consulting. Is this what later morphed into private equity?
Well, that was the end point. So I'll give you a sort of a condensed version of the journey from internal management consulting to private equity. After a couple of years in the internal sort of consulting aspect of the business, at that point I was immersed in the financial world, but I wasn't working on the front line of the financial stream of activities for JP Morgan, whether it was investment banking or investment management. And so I pestered the person who had to go out on a limb, who was managing basically the junior analysts. And I pestered the person who was responsible for saying, okay, Pat can go from the operating environment into the finance environment. It took about a year. I think I annoyed the heck out of him for a year, because I just think he thought I didn't know what I'd be getting myself into. And it was just sort of something that I thought might be kind of glamorous, when in fact I had a really keen interest for it. So eventually he relented and threw me into debt capital markets as an analyst, which was a new stream of business for JP Morgan. This is in the early 90s. And it would be fair to say that that was a stressful, hard environment to work in terms of the group getting new business for JP Morgan. And I was doing the grunt work, the very grunt work. And I survived a year. And so the guy said, okay, we'll try you in investment banking, and if you survive there, we'll put you through some more formal training. And somehow I managed to get through that investment banking and M&A world for a couple of years. Worked on some interesting transactions, but again, I was building sheets. I was putting together PowerPoint presentations. I was doing running around all hours of the night doing whatever it took. So it wasn't particularly glamorous, but I was a sponge learning. And then I did have an interest after a few years of that in exploring what this private equity business was that JP Morgan had. And that's when I think the confluence of of being immersed in an entrepreneurial environment, in this instance being the sources of capital for startups, as well as like leveraged buyouts and whatnot, the whole realm of private equity. And that's when I really started to think I want to get involved in sort of in the investment side in some way. So I landed in the private equity business of JP Morgan in around 1996 or so. And that was when private equity was just becoming a really big asset class globally. It was sort of a cottage industry till then, but then all of a sudden it was taking off. And I had the good fortune of timing and luck in that I landed there before they handed that business over to a gentleman named Brian Watson, who was a very senior member of the executive team of JP Morgan globally. And his remit was to build that business, to grow the private equity business. And I was a junior grunt, so whatever bullets were flying around above me didn't hit my head. So I ended up surviving the reformation and growth of that business. And it was through that I built a really good working relationship. And I'm, to this day, probably the luckiest business development or career development for me was getting Brian as a mentor and learning how he thinks, how he invests, the measure of calm you bring to stressful situations, et cetera, et cetera. So, and Brian was originally, grew up in South Melbourne, poached from Woodside Petroleum by JP Morgan and brought over to New York. So eventually he moved his family back to New York in around 2000. All of his kids were born in the States and he wanted them to have some time in Australia. And I followed him over in 2001 for what I thought would be, because New York had started to tire me out at that point. I moved over in 2001 to work with Brian in the Australian private equity arm of JP Morgan for what I thought was going to be one or 2 years. So it was kind of a cool thing to do, to come to this crazy, wild place that I hadn't spent much time in Australia, be involved in private equity, work with a guy who I knew and respected and was fortunate to work with. I'll do that for a year or two and then head back to the States. And that was 21 years ago. I still haven't been kicked out.
Can I just circle back? You said, you're in the debt capital markets part of JP Morgan there for a year and then in investment banking for 3 years. Can you give us a sense of kind of the work environment? A lot of people that listen to the show do think about the glitz and the glamour of investment banking, and they think of it as very lucrative. Maybe some of them do know how intense it is, but can you shed any light on that for us?
Yeah, sure. It's probably changed a bit because it was a little while ago that I was there, but I think some aspects of it haven't changed given what I read and hear about. It is a very, very stressful and difficult work environment where you work very long hours. As a junior resource, you work very long, stressful hours. It is very cutthroat. I just remember at some point, there were nights when I'd go home at 5 a.m, take a shower, put a suit on, and go back in when there was a deal a business we were trying to win, and that's because Morgan Stanley was across the street from JP Morgan, and if we didn't work that hard, they would, and they might get the mandate. So that's a bit of an extreme example, but not highly uncommon in terms of the hours. And as for so you do that to try to work on deals that close as opposed to those that don't, for people who have influence and sway within an organization, so your career trajectory can move up. Because you're getting paid decent coin when you're a junior, when you're that sort of analyst and junior role, an associate. But New York isn't cheap, so you're not exactly saving squillions of dollars at all. So the aspiration, if you've got the temperament, the desire, the adrenaline, and everything else, is to get to this more senior levels where the compensation becomes more significant, which it is. I always had a bit of a mental probably debate with myself. I've got a brother who's a teacher of 35 years, and the disparity between what the teachers who are having what I would argue is a pretty big impact on society, what they get paid versus what people who eventually get to the top echelons of Wall Street get paid. But that's for another discussion. I kind of started to chip into that slightly higher level, but I never got to the really super high level of executive stuff at JP Morgan. I was mainly in the learn and get whatever experience I could get, because I sort of backdoored my way into finance. But I'll just mention real quickly, it was about 1997, about 7 years through my time there, that my father passed away. That was the time that I probably got a paycheck where I had a few bucks outside of what we would call super here to invest. And that was when I really, because in private equity, you're investing JP Morgan's balance sheet or a fund that JP Morgan's raised. And your job is to do that well, but it's not your personal money and not your mom's livelihood. So when my dad passed away, I had to take his investments, which were 8 or 10 kind of blue chip American company, General Motors, Marriott hotels and whatnot. And I had to reconfigure Dad's portfolio into something that would be more suitable for my mom. And that was a bit of an eye opener for me, because I hadn't really had to do that before. And I can unpack that a little bit in terms of that was my first experience of putting together a very well diversified portfolio using index funds, thinking about a time horizon and a risk profile. Because it took a little while, and it was really hard. It was much harder than somebody who had the experience that I had. It was harder than I thought it would be and should be. And it was stressful, because this was, a parent's livelihood who had to pay bills, and what's the right mix of income versus growth, and how long the horizon are we talking about? So there needs to be a measure of growth, but if there's a 5-year bear market, then I'm not going to sleep at night and think I screwed up my mom's financial setup. So I did spend a lot of time at that point thinking about portfolio construction, portfolio management. Index funds at that point were really becoming big in the States. This is, again, 1997, so 25 years ago. And it was a really quick jump into the deep end of hands-on asset investment management, and both personally as well as family. So anyway, that was probably one of the most salient, impactful 12 months or so of my life. So that was 97, and there was a lot of market volatility in the aftermath of that, and probably it was the initial underpinnings of what eventually became SixPark in terms of the robo advice service. Thinking about where there should be a better solution. If I found it hard, I thought to myself, then people who don't know what an index fund or how shares work, how the heck are they going to get help? And that was one of the motivating factors behind setting up the business.
Pat, people would probably hear that and think, if you're working for JP Morgan and you're working on Wall Street, investment banker, surely that would be so easy and so simple for you to design a portfolio for your family. Like, that's probably what the outsider's view is. And I'm more curious, maybe not so much with that one, but more so with, if you are in the cockpit of Wall Street, you've got experts around you, you are an expert yourself. How did you make the decision to go with index funds?
I was immersed in Wall Street, but I wasn't immersed in picking one stock over the other. And I wasn't immersed in active investment management. When you make a private equity investment, you're making it for 7 to 10 years. So, and we built a portfolio of private equity investments across different geographies, industries, and whatnot. So I did have a good appreciation for diversification, for company analysis and people analysis, because in private equity, usually the success is typically defined by people as opposed to market opportunity. Usually the idea is okay, it's whether the people can do it or not. So to your question, Owen, I think I wasn't a professional money manager, even though I was in Wall Street. Professional money managers on Wall Street make up I don't want to say a sliver. There's a lot of activities that happen on Wall Street in addition to active fund management. And so I would have had to, quit my job and say, I want to become a fund manager. And I didn't want to do that, in part because I learned during that moment, during those times that I mentioned earlier, it's bloody hard. And if you're then going to do that with individual stocks for all of your assets, then you're going to be looking at those every day. You're going to wake up and you're going to read the paper. And if you see a name of one of your companies, you're either going to pat yourself on the back or shit yourself. That's a daily experience I didn't want to go through. So particularly given it was my mom's financial livelihood, putting together a basket of ETFs, and in the US, those are like state and county bonds, a variety of things that were well diversified, and Vanguard's International Shares Fund here at over 1,500 companies. I'd much rather have that be something that, both in my mom's case and mine now, where I feel like I'm maybe not going to get the side of jagging one of my stock selections, but I'd much rather take a good blended composition of different asset classes. So I just think it makes life, well, first of all, there's a lot of evidence that suggests that over the mid to long term, it's low fees and diversification are probably going to get you the best outcome. Sort of along the lines of, Owen, what you articulate as your core strategy. And I really liked reading about your investment philosophy. And so mainly long-winded way of saying, I didn't want to take on the stress, time, and behavioral challenges that active stock pick took for the core aspect of my and my mom's assets.
Fair enough. I like it. So you arrive in Australia and you're down here, at least one person, and you're working in private equity. Can you take us through, I guess, that period of your life up until where the origin story of SixPark begins?
Yeah, sure. One of the things, as my time in Australia started to expand, one of the things I talked with Brian about for a number of years, actually, was the prospect of he and I starting up our own business. Because Brian, at this point, he was on the original board of guardians for the Future Fund, so doing effectively asset allocation with the country's sovereign wealth fund. And he's a little bit older than I am, so he was not really in an operating environment. He wasn't in an operate a company mode, but very much in a sort of a mentor, chairman, advisor mode. So he and I had talked about the idea of creating our own business, because we'd been sort of funding or advising others' businesses for ages. Where I would be fundamentally the operator of the business, and Brian would be in a more of like a chairman capacity. What we needed, Owen, is we needed the idea. We needed the business idea and the business opportunity. So at this point, SixPark and Robo wasn't in the brain. Yep, this is 2010 to 2014. Every time I went to the States to visit family, I would always go over and think, what I want to identify a trend in the States that's going to be a big trend in Australia in 5 years, because there's the idea that Brian and I can capitalize and have a crack at, and if it goes well, great. If not, I can say we tried. We can say we tried. So there was a period of time where I struggled, and notepads on planes and whatnot, long plane flights, but there was a moment in 2014 when the ETF market in Australia was starting to really become more significant and relevant. And Brian and I, both on a personal and professional level, could see the major problem in Australia, more acute than overseas, of it being too hard, too confusing, too expensive, if people could even get a quote, so to speak, to get investment help, to get advice, not just a menu of choices, but actual tell us a little bit about yourself and answer some important, salient questions. And we're not going to solve all your financial problems. We're not going to give you a holistic statement of advice about what to do with this and insurance and super and estate planning. But if you just, we do one thing really, really well, in my view. We've got a good group of people to help construct a portfolio if somebody has some money to invest. And we thought that the ETFs are now there to construct portfolios in Australia on the ASX. I learned very quickly what an API was in terms of the technology required to deliver a risk assessment and trades and portfolio construction. And if we build it, rebalancing, automated rebalancing, automated onboarding, portals so clients can see their holdings, so on and so forth. That was the idea. If we built something like that, that would be high utility in Australia if people like it and want it and use it. And we could see it happening overseas. And Australia is, on the financial services front, is typically a little bit behind what, accelerates overseas and in parts of Europe. So anyway, so we thought, given the asset allocation expertise, which is an important one, that Brian and at the time, who he had envisioned pulling together as an investment committee, and me kind of going out and saying, can we build a tech platform that will, an application and service that will do all this stuff in a at least mostly automated way, because otherwise you can't charge a low fee because you've got too many costs all over the place, and you want to scale it up, so you need automation. So we did like a year's worth of proving this thing out, and putting together the different pieces for trading and reporting and rebalancing, and a lot of spreadsheets that I still have on asset allocation and rebalancing. Built a mean variance optimizer to work the investment committee would use if we got to the point of building and launching, and which we did, obviously. So this is about 2014 to 2016. So we got the idea, we got very excited and passionate about it because we could see the need, and we thought this is exactly what we should be doing, right? Given the background, given our background. And importantly, both Brian and I shared an investment philosophy about low fees and diversification being the two most important decisions an investor can make. There's a lot of factors, obviously, but those two really resonated with us. And so if we can automate a way that people can access that at an accessible and affordable price point, that really got us fired up. So we built it and we launched it in 2016, and thrilled with how it's going. Awareness and adoption of ETFs and digital services it has been increasing sort of each year. It's kind of following the trajectory of what's happened overseas, where people have investors, and it's not just people and you probably know this, but it's not just people who are starting their investment journey. Obviously, that is a very, very important segment of the market because those people need help, and they're typically young. So if they're making either poor or uninformed because there aren't any ways for them to learn, a few bucks opportunity cost today is a lot of money in 25 years. So that's an important segment. But there's also people, and we have them as clients, that have millions of dollars, and all they want is a simple but effective portfolio that they understand, that they have line of sight on. They can see what the asset classes are. They can see how the diversification works. They can see through up and down market cycles the power of that diversification and reinvesting dividends, et cetera, et cetera. So it is sort of a mass market solution, but it can cater to a lot of different people depending on what they need. So anyway, that's sort of how we went from, gee, we should start up a business someday, to the idea, to then building it, and then getting Lindsay Tanner and Mark Nicholson on the investment committee. Because the last point I'll make on that, Owen, is one of the things that we wanted to make be special about our business was, it's not easy, but you can automate all the stuff that I mentioned, the risk assessment into onboarding, creating account portals, this and that. it's easier said than done, but it's, obviously it's doable. But ultimately, people give us their money to invest and generate a return. So you do need a measure of expertise in figuring out what asset allocations and which ETFs to choose. And I built a few formulas and algorithms for things, and a mean variance optimizer, which is, for those who may not be aware, is sort of a highly analytical tool where you can put in different types of investments, expected risk and return, and say what your goal is as far as volatility or returns, and it will kind of give you a suggested asset allocation across, based on what domestic shares, international shares, property, et cetera, et cetera. That is just a tool that should inform a decision, but not be the decision, because by definition, every mean variance optimizer is going to be a little bit subject to the assumptions you make and sensitive to them. So what you really want is a group of individuals that take that and then say, okay, let's apply our real world experience and see if we want to tweak some things around the edges, because this thing is a tool, but it's not perfection. And that's where our investment committee, we wanted our clients, whether it's their first couple thousand or substantially more, to know that there's people behind it looking after the inputs into the automation. As Lindsay said in one of our first investment committee meetings, which I'll never forget, he said, you can't build an algorithm for Trump. And what he meant by that was, well, it's sort of self-evident, but we had to make a lot of investment decisions or decisions not to do something to our portfolios when Donald Trump was elected, which was something that a lot of people didn't think was going to happen. And this isn't a political statement, it's just a statement about the time. There was a lot of people worrying about what does this mean about shares and global markets and the global economy, and broadly speaking, how should I change things? Our answer was, you don't change anything. At the time, you don't change anything in your we didn't change anything in our portfolio construction, because presidents typically don't drive global economic and share markets. So it's stuff like that we wanted to ensure that there was a good team of people sitting on top of the automation. So I'll stop there. That was sort of the construction of the service, and launched in 2016. And it's been a heck of a lot of fun.
It's fascinating just to hear you speak there, Pat. As you were doing that, I was actually looking at some of our survey responses. So we have our own memberships services, and within that, we have one that does like fund research and whatever. And what's fascinating, when you talked about not just being new people to the platform, like you can go in with thousands of dollars, you can go and get a SixPark account, or you can go in with hundreds of thousands of dollars, right? And we see that playing out with ETFs more broadly as well across our investor base. About 1 in 5 of our investors that focus on ETFs have been investing for more than 10 years. So I think, at least for me, it was a surprise that so many investors are very experienced, rely almost solely on ETFs as their vehicle to grow wealthy, it caught me off guard. And across all of our memberships, ETFs are more popular than individual shares now. And I just think that's, I think a lot of people that when I speak to them, Pat, they are active investors and they don't comprehend how big this shift has been. Maybe if we can, just for a moment, maybe just explore what we were talking about off air before we hit record, about how you see SixPark and the industry shifting in the future, and how the mix of actors and different stakeholders in our industry might change through time.
In terms of how those services are delivered, and therefore what do people's investments approach look like in the coming years? I think
exactly.
I think we're going in Australia through a really exciting transformation, and transformation has, by definition, always has its bumps in the road, but ultimately is leading into a better place. The banking and financial services industry obviously has had a few issues over the last several years. And so there has been a lot of review of the way in which people receive financial services, in particular financial advice. And I think we're at a point now where the innovation to drive better, more efficient more accessible. And when I say better, I mean, good user experience, transparent, and all that comes with services that people want on the financial services side, where innovation has caught up to the need, and a fairly archaic industry it's sort of like turning the Titanic is in fact sort of starting to turn. So, and probably just bringing that to life a little bit, overseas, a few years ago, the likes of J.P. Morgan, Goldman Sachs, Morgan Stanley, Credit Suisse, HSBC, even Walmart and others have started to get into the realm of digital financial tools and services to reach the next generation of investors, because there's going to be an intergenerational wealth transfer of trillions of dollars over the next 10 years or so. And so existing incumbent financial institutions are going to have to, I think, learn how to serve that cohort soon, as in now, or innovative companies with solutions will do that and start to take those people away from the big banks and other large institutions. So what I think we'll see in a few years is the combination of a number of these services into a more seamless experience for people, where earlier in their wealth creation journey, they are getting what is right now a bit ad hoc and hard to kind of make heads or tails of, but it's sort of starting to weed itself out. Budgeting tools, access to platforms like yours that give them insights. I won't use the word advice. Insights, information, and tools to learn about investing and shares and whatnot. Services to help construct and build portfolios. Obviously, we've seen the advent of low-cost trading platforms now in Australia, which has been an incredibly rapid development in the grand scheme of things over the last 3 or 4 years, from $15 being wildly low, given the track record in the industry, to free in some instances now. That's a good thing. It's also kind of a dangerous thing, because people can be reckless if things are free. So, and then what I think will happen is people will be able to access financial advice during the bespoke pieces of their wealth journey. So investment management, accumulation phase, estate planning, retirement planning. It won't just be that there's one point in time when you have a whole bunch of money that you finally are able to go get help on that front. There'll be a continuum of this. And right now it's pretty disparate all over the place. And so it's kind of hard for people to figure out, because we all have jobs and stresses in our lives, and not everyone can immerse themselves in their wealth management activities. So what I see is the transformations starting. I see government actually really starting to put its weight behind the desire to innovate with the customer in mind, which has not always been the case in this industry. The regulator doing the same. And we're seeing a few of the big banks start to talk, I think, a bit more genuinely about adopting technology to get help for people that need it. And I would expect you'll see non-financial services entities providing wealth tools to their consumer base.
I guess the financial wellness, as you put it, becoming more of, I guess, ubiquitous throughout the ecosystem. So whether you go to an airline's loyalty program and get access to a wealth platform that way, or whether you go onto Woolies or Coles website and you access it that way. I think it's a fascinating thing, and I think that as with finance as we know it today is not going to be what we know it as in 10 years. There'll be obviously remnants of it, but the more cutting edge will be totally different, and I'm really excited for that. If I could quickly loop back through your investment philosophy and process, Pat, one of the things that when I've spoken to other people in the industry about SixPark, one of the things that often is brought up is that you've never invested in gold, at least as far as I know. So I'm wondering, when you do your mean-variance optimization and you look through your asset allocation, why that never factored in to the asset allocation?
It's a good question. So we assess that when we launched, and we continue to assess it because, like we would any other asset class, as we do with other asset classes. The relatively short answer, Owen, is when we constructed and continue to manage our portfolios, we prefer growth and defensive asset classes that we feel like we've got a certain level of understanding about the risk reward profile. And on the defensive side of asset classes, we really want income. So let me preface all this. We don't think gold is a bad investment for a portfolio. It's just we prefer to do things, we prefer to use other components instead of gold. So to be clear, it's not like we don't think it's a good asset class per se. It's just we have a preference otherwise. So we have a preference for defensive asset classes to generate income, which gold does not. We also did a pretty deep dive on the performance of gold over time, both actual just the price of gold, as well as some of the exchange traded funds that track it both in the US and in particular here in Australia. And what we found is that it's got more volatility than some people might think, that the case that it's a hedge against inflation works sometimes, but sometimes doesn't, depending on the backdrop. When we put sort of all of that together, what we prefer is to, if, let's say we were going to have a 10% allocation to gold, we'd rather take a portion of that 10 into a growth asset that we know and understand, and the remaining into defensive asset that we know and understand, both of which are generating income, and both of which are relatively well understood from our perspective. So that's where we landed, and we continue to sort of reflect on that. And like I said, with any asset class that we feel becomes prudent for adding to our portfolios, because we've done this over time. We added infrastructure at one point, global infrastructure listed. We'll think about it, but we haven't gotten there yet. And what does that mean? It means when gold, when it has its moment, when it shines, so to speak, it's a real tailwind in portfolio performance. And when gold sort of languishes, and it can have long periods where it does that, it's had this is the price of gold. The price of gold has had a 10-year period where it was flat, and during those 10 years there was not a dividend paid. So again, that was the price of gold, not the ETF here in Australia. We are long-term portfolio managers, and so what we determined was, on balance, gold's a drag on performance over time. It works really well for windows, and then it less well for other slightly longer windows. That was our conclusion. So it's done well recently, and we would expect it to. I've found it interesting that it's performed well the last couple of years, and then some of the times when the inflation fears were at their most acute, it retreated, and I just could never. There's some aspects to its performance that I don't fully understand, which is part of the reason we sort of decided to go another way.
No, that's fair enough. I just see it as a point of differentiation for you as well.
Yeah.
And gold tends to be quite a polarizing thing for that very reason. For a long time, I've thought very similar to you, in that I probably don't need gold in a portfolio. As a long-term investor, I probably don't need it to construct a portfolio, but I acknowledge at certain times it has worked, and over time the price of gold has gone up. But
one of our investment committee members, Mark Nicholson, was on the investment committee of the World Bank, the banking division of the World Bank, and I think he summarized it succinctly and well, and in many ways, like you just did, Owen. Where he has seen in his career, and it's an impressive career, where he's seen gold utilized most is by hedge fund managers that will choose it when they're making a bet before others that it's going to outperform. So there is some real alpha seeking with it by professional managers. Obviously, retail investors will use it as well, but where he's seen the most activity with it is that use case. Otherwise, it's a little bit more of an insurance play. the insurance part being the drag that I talked about. So neither one of those kind of fit into how we manage portfolios. Anyway, I just thought I would add, because Mark always has interesting insights on these things.
Yeah, no, I like it. And I do see it personally, whether it's on the advisor side or on the active management side, whether it's private investors or professionals, I do see it as more a tactical shift, whether that's for alpha or whether it's to hedge against something and then therefore alpha. That's where I see it being used. I've got a more product-centric question for you, Pat, which is just that if I could ask you to pick one of these that have been most powerful or had the most powerful impact on your clients, and I'm giving you a false choice here. I've got automation, investment philosophy, or I guess security selection / investment process, depending on how you want to think about that. So we've got automation, your investment philosophy, or your security selection. Which one do you think has had the most powerful impact on your clients?
I think the most powerful impact would be the investment philosophy, because ultimately people are giving us, trusting us with money to invest for them. So we benchmark ourselves a variety of ways. Probably the most meaningful way that we're able to is by looking at a database of managed funds, multi-asset class managed funds. And we can see growth defensive split, so we can line this up against ours and say, how are we doing against comps? And we've regularly outperformed sort of 80, if not 90% of those on a regular basis since we went into the market sort of 6 years ago. And so that I'm very proud of that. I think it's a combination of low fees and that investment oversight to make good decisions at the right time, or decisions not to do anything if that's the case. So I think that and I hope it's appreciated, but when markets are down, you don't know whether people think they're getting good investment guidance or not. But I think we've delivered strong returns, and that's probably the most important thing we're supposed to be doing for people. So that would be the thing that comes to my mind. I think as far as if we were to ask our clients, the automation is probably part of it, because I try to spend a lot of time talking with clients, because it helps inform product development and feature enhancements and whatnot. And the thing that I hear probably more than anything is the concept that it's like set and forget, but with an adult overlay, keeping an eye on things to tweak when necessary. And in that mind, there's both the technology automation, but also I've given it to you guys to just let it do its thing. I can retake, this is a client speaking, can retake the assessment if I think my risk profile might have changed, or if I just got fired, so my time horizon for this money is now 2 years instead of 22 years. So I need to retake the assessment and this and that. I think that automating and building transparency and how that works has probably peace of mind. Has probably been the bit of feedback I've gotten most from people.
It's actually interesting because this segues perfectly into my next question, which was about behavioral biases. And you may know that Teddy Richards, former employee of yours, was on the show, or was actually on our Australian finance podcast, or our other channel, but he talked about behavioral biases. And just maybe, as more people adopt robo advice, or more people adopt ETFs and passive investing in general, what do you see as being, I guess, some of the more powerful psychological biases that people should be aware of?
It's a really good question, and one that I would encourage anyone listening. I know you have a range of very sophisticated audience, and probably people who are fairly new. I would say for anyone, it's always good to revisit what behavioral traps there are for investors, because no one is immune to those. Whether experienced or not, and I say that from personal experience. So, but I think today, as we sit talking today, Owen, three that come to mind. One would be, and I don't know how this would be sort of technically framed in an academic behavioral finance book, but it's has to do with patience and managing emotions. And the way I see that is people make plan when things are reasonably sort of stable and markets are kind of grinding their way up, and there aren't any like huge traumas in the world. People set plans for themselves from a finance and investing perspective, and they'll sit and spend a lot of time and answer questions of themselves and their goals and their time horizons and whatnot. They put together a plan and implement it, and then the doo-doo hits the fan, and something wacky happens. And all of a sudden that plan is just gone. And it might be right that there should be some adjustments to the plan, but it shouldn't just go out the window. And a lot of people, I think, need to really check those emotions and remember that trading is a short-term game, but investing is a long-term game. And investing rewards the patient. So that would probably be one of them. Another one that's sort of a, an obvious, well, not an obvious, it's always an obvious one. The concept of the follow the crowd, the herd mentality. They're, can talk a lot about GameStop and all these other things and where there have been fads or trends. One thing I did learn in time in New York and Wall Street and just anecdotally from people, more times than not, when there's a major trend or hot space or whatever you want to call it, professional money's already gone there and prices already reflect to some extent the run up in that, whatever that might be. So either one of two things going to happen. Most, a lot of investors will be getting in a bit late, and therefore the upside isn't as great as they may think, or the fad or the trend is exactly that, a fad or a trend. And just because a whole bunch of people are throwing money in it doesn't mean it could just fall, the thesis could fall over the next day. So do your homework. If you're doing something that there is in fact a herd charging at, have a really, really thoughtful consideration as to if you strip out the herd, do the fundamentals still hold? And if the herd shifts and goes in another direction, are you going to follow them, or are you comfortable with your decision? Because if you're not, that says something. So that would be a second. A third would just be, generally speaking, overconfidence, which is frequently thrown into the behavioral finance mix. You won't be surprised to hear me say, "Oh, and I think investing is really hard." Given my comments earlier when on my own experience, picking stocks 15, 20 years ago, there was an ability to get an information edge. So professional fund managers, active managers, and retail investors could eventually avail themselves of information that, if they worked hard enough, could inform a decision that other people might not get to. Information's everywhere now. In fact, there's almost too much information around. So it's really challenging to find an edge. It can be done if you've got the time, temperament, interest. It can be done. I really like the way you frame in your investment philosophy, like the core kind of passive piece, the like the Rask ring, maybe, if I don't know if that's what you call it, but sort of kind of how you try to really thoughtfully and analytically make very measured assessments of some investments to make, and then outside of that is you having a bit of a flyer, and I think there's a home for all of those, very much a home for all of those, including that last one. And to me, that's when I get the calls all the time. Does SixPark have crypto in his portfolio? No, we don't have cryptos in our portfolios. If you want to do crypto, go for your life, but I wouldn't put all your assets into crypto. And if you want sort of a core, this might make you sleep a little bit better, because crypto can be kind of volatile. So coming back to my third point, overconfidence. A lot of people who are newer to into the market now, up until a few months ago, have basically just seen like markets grind up for 10 years. And at the tail end of that, a pretty speculative, kind of spike, particularly right after COVID in March and March of 2020, when we had the quickest correction in the history of markets, followed by the quickest rebound. And I think there were a lot of people at that time getting access to low-cost brokerage in cash and going, well, this is actually not that hard, right? We've just had, we're in a pandemic and I'm making money. That's not how it always works. And people will be learning that now. I am actually quite glad to hear some of the stuff out of your comment about ETFs. Same out of Self-Wealth and ShareSite and some of the others that are giving some commentary about their customer behavior. There does seem to be a measure of patience and long-term thinking with investors through the utilization of ETFs, and importantly, which ETFs. It's not, it's not some of the more specky things. It's the big global, established, large, diversified ETFs. So anyway, overconfidence. I guess I would just close out saying investing requires humility. It requires conviction and a variety of other things, but it also requires humility. That it's hard.
I like it, Pat. So you've got patience, or maybe impatience, being advised. You've got herd mentality, and you've got overconfidence. I really like it. I love these conversations, and I think they're more important, and I think they're going to be more prevalent as more investors think carefully about their asset allocation, because that becomes their primary decision that they make, particularly, like you said, in the core of a portfolio. I've got one final question. Actually, I've got two questions, Pat. First one is a quick one. Why did you call it SixPark?
One of the most difficult things about setting up the business was coming up with a name. Phenomenally difficult. We had all sorts of ideas. They were either taken or there wasn't unanimity about whether we liked them or not. All these, rocket ship, this, that, all these names you typically hear of these types of businesses. There was a name that was personal to me, in that that just kind of made the cut until the end, and we stuck with it. SixPark is the address of a family beach house in the little state of Delaware on the East Coast that my grandparents bought. And it's a 80-year-old, fairly large but not modern beach house that my grandparents got when my grandfather retired from the Army. And they said, all family is coming to us now. We're not going to go traveling around the world seeing family, come to us. So we had the good fortune as grandkids of spending our summers at this big old beach house with all the aunts and uncles and grandparents and whatnot. It was sort of paradise for us. And one of the things about it was that it was a place that I personally felt quite safe, because there were adults sort of always kind of running around just making sure things didn't get out of hand. So I felt kind of safe and secure there. The house weathered a lot of massive easters, which are big storms on the East Coast of the US. And for me personally, it just sort of resonated with exactly what I wanted the business to do, which was let people know that it's got a sturdy foundation, that there's adults looking after things, that you can enjoy life and not worry about, the stuff you don't need to worry about. So that's where we ended up landing. And that's the background of that one.
I like it. Okay, final question, Pat. Is if you could go back and tell younger you one thing about money, finance, or investing, what would it be?
I'll keep this one simple. Start earlier. I mentioned earlier that when you live in New York, you can be on Wall Street, but if you're not in one of the sort of super high flying jobs, after tax, you're not saving a lot of money. If I were telling myself something, again, it's pretty basic, but I think it applies to anyone. The power of compounding interest, I won't elaborate on. I'm going to assume your audience knows that one. I didn't have a budget while I was starting my career in New York. I just was trying to do well on the job and have some fun at the same time. I probably would have had an earlier, more disciplined approach to taking a portion of each paycheck and just putting it into the S&P 500 or something like that. There's lots of other lessons along the way, but I don't think you can beat the start early, because you can't start early unless you get control of, am I spending more than I'm earning, or and if so, you can't start early. So there's a lot of really positive flow-on effects from it, and you're stunned when you look at those accounts 20 years later and go, I was putting tiny little bits in back then, and now it's, it's this. That's time, and it's very powerful.
Yeah, I like it. It's one of the most common pieces of advice that people would give their younger selves, and it's easy to see why. And I think a lot of people, think that they can invest their way out of a savings mistake, and I don't see that happening very often.
Nah.
Yeah, I've got to say, it's obvious why it is such a good piece of advice. So hopefully someone out there is listening who is in that situation. Maybe they're probably not on Wall Street, but they might be in a good job and they're thinking, well, how can I make, some of this go somewhere meaningful? And that's a way to do it. So Pat, from SixPark, I really appreciate you taking the time to join me on the show today.
I really appreciate you having a chat. I always enjoy these kind of chats, Owen, and really enjoy what you're doing.
Thanks, mate. Appreciate it.